but you know, now you're chasing, and here you are stuck with $1,009. It is December 1st. Hope you all had a great Thanksgiving. After I show you the account briefly, I'm not going to take you through it because I already did on Friday. I will talk about how I think of selling call options and what analogy helps me think about it and understand it. So here's the account. I'm sitting at 74 334 still. And if you want a quick overview, here are my positions. Just gonna scroll them real quick. Nothing's changed. Chemical still down 228. Blah blah blah. Options. I already explained this in the previous video. So if you wanna take a closer look, you can look at the previous video. This is the 1 week performance. I'm dragging behind the market at the moment. This is the 1 month performance plus only 1.2%. 3 months is plus 16%. And the year, okay, that's just Robinhood doing Robinhood things. This is the old time chart. I started this account and started taking this account seriously, and the YouTube channel somewhere around August here, August 28th maybe. And so this is the performance after August 28th. Pretty dramatic. Now, that's the account. So let's get into selling call options. And the analogy I like to use is one of a cup filled with sparkling water. And so what I've drawn here with my amazing drawing skills is this. This is my cup representation. And basically, the level, I know it's very artistic. So what's going on here is the cup represents, the water level represents the price of the stock. Now it goes up and it goes down. So, you know, that's how stocks move. They go up and down, or they stay still. Now, what you're getting paid to do was an option call seller. Option call seller is you're getting paid to draw a line anywhere on this cup. And basically, what you're being promised is the level of all the water that's underneath that water, that level, at expiration date. Okay, so let's say the expiration date is a week. Expires in 1 week. Okay, this is impromptu. That's a really horrible K. Let's fix that. So expires in a week, and you're getting paid. This number would actually be higher than 100, but anyways, a little bit. Let's say you're getting paid $100 for drawing this line. Now, if the water rises or stays the same, you're basically forfeiting everything that goes over $900. All right. Okay, let's make this more realistic. This would be like $109. Okay, getting paid a little bit more. So you're gonna be getting paid everything that's underneath this cup. So that'll be $900 plus 109. So that'll be $1,009 no matter what at expiration of 1 week, if the level of water stays above this line. Now if the water sinks, okay, what's going to happen is there's not going to be any sell triggered. All right, so let's say the water goes at this level right over here at the $800 level. So what's going to happen then if the stock goes down? I'm not going to collect $1,009. I'm going to get to keep my stock that's valued at 800, plus I get to keep this as well. I get to keep the 109. So my account value, if this is the only position I held, would be sitting at $909. Okay, so that's what's going to happen. So even though my original investment was 1,000 and the stock dropped all the way down to 800, my account value is now 909 because I've sold this in the money call option. It's called in the money when you draw the line below the level of the water, and it's called out of the money if you draw the line above the level of the water. All right. Now, out of the money options will cost a lot less, all right? So let's say I sell a call option that's up here above the level of the water for $1,100, then I would probably only get for that option, you know, something like $9 instead of $109. Okay, now what's gonna happen in this case? Same thing. All right, you get to collect and keep the position as long as the level of the water stays below this line. So if it stays at 1,000, then great. My initial investment of $1,000 is now worth 1,009 because I get to keep this premium no matter what. All right. Now, if the level of the water goes above 1,100, let's say it parks right at 1,100, all right, then my account value would be now 1,109. So I'd be up $109 in my account, or my position. If it goes above that, I don't get any of these gains, all right? If it goes above that, I don't participate in any of those. I just am hard stuck at 1,109, okay? Which is kind of what happened with my call option with Apple. But I'm still in that call option because I want to, you know, I want a form of insurance. I want to counteract the potential downside of the stock because I think it's a little overvalued. But it's a different discussion, all right? So let's stick to this. So let's review it real quick. Okay, I have an initial investment of $1,000, all right, which is where this water is right now. I'm getting paid to draw a line. The lower I draw this line, the more premium I'm gonna get paid. All right, if I draw it all down all the way over here, okay, then I'd probably be getting paid, you know, let's say it's a 700 in the money strike price, right? Then I'd probably be getting paid like, you know, $309. So I'll be collecting that premium. That's really ugly, don't worry about that. I'll be collecting this premium here, okay, for the 700 in the money strike price. So the lower I draw it, the more premium I'm gonna collect, okay? The higher I draw it, the less premium. In fact, if I draw it over here, way up high, then my premium is probably gonna be 0, okay? Because nobody's gonna trade that, all right? Nobody's willing to buy a call option from me at, let's say, 3,000, okay? That's way out of the scope of the cup. So they don't think that the cup is gonna go all the way up to, fill up all the way to 3,000. Therefore, no one's willing to buy that call. But if someone is extremely bullish, you know, maybe they'll give you like 50 cents or something like that. Although the brokerages don't trade at this kind of increments. I think the lowest one you can do is $5. But in any respect, that's how you do it. Now, if you want to understand this, just review. You can backtrack, rewind, freeze, look at it, whatever you want. Now, let's go and do a real example here. Let's say we're trading Apple, which is, you know, one of the biggest companies here, and we want to play Apple because it's liquid. Liquid means there's a lot of participants, a lot of options being traded back and forth, etc. I'm going to click trade options here on the website, and this is my cup, okay? This is the level of the cup right here. It's 267.44. That's how much water it has. And this is all the sparkles. No, I'm just kidding. All right, so if I want to sell a call, right? You pick expiration date. So let's say in a week. If this is an in the money call, sell. So let's say I want to sell it for 250, okay, which is below the current price. It's in the money. And with sell call, that means I'm going to get paid $1,735 for selling that call. And I'm also promising to only keep whatever Apple's worth below 250 by that date. So if Apple closes at 255, I only get to keep 250 worth of Apple shares, so 250 times 100, plus 1,735. Okay, because every contract is worth 100 shares, so that's why you multiply by 100. All right, now if I go further down, let's say to 200, way below the level of the cup, then look how much I'm getting paid, right? I'm getting paid $6,758 I'm going to receive in premium. However, I only get to keep whatever Apple's worth under $200 by that date. So if Apple's worth over $200, I have to sell it at 200 and collect all the premium plus the cash from the sale. If Apple's below 200 in a week, highly unlikely, but could happen. It's possible. It's within the realm of possibilities. Then I get to keep whatever Apple's worth. I get to keep the stock, and I still get to keep that $6,758 premium. All right. Now, let's take a look at out of the money strike price, which means it's above the level of water that the cup currently has. This is the level of the water. Let's say we go for $300. Okay, these are outlandish numbers, by the way. You wouldn't trade that. Okay, let's get something closer. So let's go 270, which is almost, it's $2.66, 56 cents above the current price. So if I sell this call, this out of the money call, you see how it's drastically lower amounts than the one underneath, right? I'm only going to be getting $140 for selling that call. In exchange, I promise that I get to keep everything that's under this level. So if the water stays under this level here, under the 270 level, I get to keep my stock, and I get to collect this premium of $140 because I got paid to draw a line, right? That's what you're getting paid for. If I draw the line a little bit higher at $275, okay, because I want to have more room for the water to, go up and down. I want to make sure that I still get to keep my stock at the end of the date. Then I'm only going to get paid $39 for that. Okay, so the lower I draw the line, the more I get paid for it. The riskier my line drawing is, and risk versus reward, right? Now, all the way up here at 285, if I decide to draw the line, I'm only going to get paid $6. That's it. Okay, for my huge, $28,500 position, I'm only going to get paid $6 per week. Okay, because it's so far up in the air. No one's willing to trade me. And if I click on it, I can actually see that there are 3 bids and 5 asks for $3 and $9 respectively here. So yeah, realistically you could get $5 for it. All right, so and if I keep going further up, let's say $300, there's still people trading at this level, but if you go super outlandish, there is just going to be no people trading. Look, there's 0 bids for this one, $330, and some silly person is asking, maybe I should take him up on that offer, is asking a penny for 718 contracts. Well, that's crazy. All right, interesting trade. Wow, maybe it's the same person. Sorry guys, interrupting because this is just very interesting. Okay, I guess no one's trading at the 320 level. Well, you can see how there's 0 bids. No one wants to buy those call options because they're just way too unrealistic, right? No one wants to waste their money. So there you go. That's the cup analogy. Hopefully it helps y'all. It helps me think about the stock level like that as a level of water in a cup. So at least that's how it helped me in the beginning. So hopefully it helps you if you're just starting out and thinking about it. I like to sell call options a lot on not all of my investments, but nearly all of the investments that I have, because it's just passive income and it's great. But of course it's risky. You may be forced to sell your position off and then you're stuck with a bunch of cash and no stock. And then what happens is, you have to probably, I don't know what you would do. I'm sorry, if the stock goes way up, you're gonna have to sell, and then you're stuck with some cash, a little bit extra cash, but now the stock value of your investment is way up, and you're not participating in any of the upside, and so you're probably shooting yourself in the foot for having sold a call against it. So that could happen, and now you have to wait for the value of your investment to come down, so you can rebuy it, or sell put against it. Maybe it's another video later. But now you're chasing, and here you are stuck with $1,009 when you could have had $1,200, $1,300, $1,400. So it's risky if you're afraid of FOMO. If you have a bad case of FOMO, then afraid of missing out. Fear of missing out. Then you don't want to sell call options because price runs up and you're going to be biting your nails. All right. Make sure before you trade you understand all the risks, and make sure that everything you do in the markets is risky. You got to understand them. Consult a professional if you don't understand anything. And I'm not a professional. Don't listen to me. Just telling you how to do things if you want to do it. But you could lose a lot playing around the stock market. Many people have. So please take care. All right. With that said, I think I'm going to end it right here. Hopefully this was a little bit educational, help some of you out. All right. With that said, peace out.